To say the last 2-3 months have been a bit shaky is clearly an understatement. There's a never-ending war in the Middle East and Ukraine. Major economies like the US, EU, China, these guys are slowing down. The Indian rupee is under pressure, valuations are a bit on the expensive side. We've seen a few downgrades in near-term earnings, and of course, the equity market here in India is down by a good 9-10%. Understandably, many of us are hesitant to invest in equities right now. And it's not just individuals like you and me. Even mutual funds are sitting on piles of cash. That's 3.7 lakh crores until the end of last month. And as a percentage of AUM, overall cash holdings have risen to 5.6%. So there is a certain uncertainty on whether one should be investing at all. And if yes, then where should one invest? At least on the first part, that is whether one should invest, a smart way of building your case is to do it mathematically using a decision tree. So given all those things I've told you, war, valuation, downgrades, blah, 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 let's say there's a 60% chance, and I'm being a little optimistic here, but say there's a 60% chance that the Nifty will rise by 20% over the next 12 months. And likewise, there's a 40% chance that the Nifty will fall in 2025, and let's say the drop might be about 10%. So very simply, 60% of 20% is plus 12, 40% of minus 10 is minus 4, and therefore 12 minus 4 comes to 8%, which must surely make you wonder कि 8% के लिए इतना effort और इतनी volatility झेलने की क्या जरूरत है? After all, ये 8% तो FD में भी मिल सकता है. So these are the kind of questions we are now asking ourselves. जब सब अच्छा चल रहा होता है तो no one cares. But these are crucial questions now, which is why in this video, I've compiled a number of safer options that one can consider for the next 3, 6, even 24 months from now if you wish to play it safe. I can assure you the options presented here are nothing that you don't know. But as always is the case, a little repetition, a little extra information is always useful and can go a long way in improving one's overall portfolio. Let's begin. Option 1 is something we are all aware of, a bank fixed deposit. Of course, one can use a savings account as well, but for bigger amounts, people generally prefer a deposit, and why not? After all, your money is pretty safe, as in banks are RBI regulated, and deposits of up to 5 lakhs are insured with the DICGC. That's the Deposit Insurance and Credit Guarantee Corporation. And remember, this is 5 lakhs per bank per depositor. Secondly, FDs are liquid instruments, and if you need the money, you can always break a deposit. You receive 8, 8.5, 9, even 9.5% in interest, and I'll show you how in just a minute. And because the interest rate is fixed, you really don't have to worry about external factors like what's happening with the stock markets, the repo rate, or something else. On the flip side, the interest amount is very much taxable, and this happens per the depositor's marginal tax rate. So if you're on the highest slab, it's 30%, but if your tax slab is lower, or let's say your parents are retired and their tax slab is at a super low rate, then an FD is by far one of the best and safest instruments for short-term investing, and especially now when the interest rates are high and handsome. Okay, so in my household, it's my parents, my father, mother, who are the big users of bank FDs, and they also use corporate deposits like the ones offered by Bajaj Finance, LIC Housing, Shriram Finance, etc. As for me, I generally maintain around 5 to 6 lakhs in FDs, which acts as a financial buffer covering a few months of expenses. But yes, in the last 2-3 months, my fixed deposit balance has gone up a bit as it's becoming increasingly challenging to find reasonably priced stocks in today's market. That said, identifying a suitable FD with a good interest rate can be a bit tedious, which brings me to Stable Money, the sponsors of today's video, and a platform that helps you compare interest rates from over 200 banks, including the small finance banks that offer a higher rate of return. With Stable Money, you can invest in Northeast Bank and Unity Bank. These are the two banks offering the country's highest FD interest rate of 9.5%. You can book multiple FDs in multiple banks. Because these are bank FDs, all of them are DICGC insured. Your money is directly deposited into the bank, as in Stable Money doesn't touch it, giving you an extra layer of security. Post booking of the FD, the bank will inform you directly over text and email. And it's thanks to such convenient processes and safety features that more than 12 lakh people have trusted stable money for their fixed return investments. The platform also features banks that offer instant withdrawal facilities, giving you immediate access to your money. And because the stock market looks a bit expensive, now is definitely the right time to invest in FDs by locking in those high interest rates. So do check out the Stable Money app using the link in the description below and give your money the stability, safety, and the high returns it definitely deserves. Okay, so next up are bonds, and Indian investors can today access a diverse range, with each bond differing in terms of the issuer, purpose, risk, return, and also taxation. Now, in my view, bonds should primarily be approached with safety as its main objective. So safety comes first, while returns can come in second. And if a bond can offer additional layers of security, then it's all the more better. For instance, one can always invest in government bonds that are considered amongst the safest investment option due to its low risk of default. But इसमें भी variations है. For example, there's GSEC, that is government securities. These are long-term bonds offering a fixed interest rate over a 5 to 40-year tenure. Then there are treasury bills that are short-term securities, state development loans that offer slightly higher returns than a GSEC, and finally there are floating rate bonds whose interest rate is variable and is linked to an external benchmark rate, which currently is the National Savings Certificate. The key thing for you to understand here is that every bond should be looked at on the basis of two variables. A, there's credit risk, and then there is interest rate sensitivity. Let me explain this. So credit risk refers to the chances of default, and in the case of government bonds, this is almost nil, which means the safety is high. When it comes to interest rate sensitivity, the longer the bond's duration, the more it's likely to be affected by changes in the repo rate. This video here provides a better understanding of this interplay between RBI interest rates, bond yields, and bond prices. But just to elaborate on what I said earlier on the additional layers of safety, if the interest rate were to go down from here, which is likely to happen in the upcoming Jan to March quarter, then not only will the investor receive the coupon, which is generally around 7%, but because the bond prices would have gone up, there is also the chance of capital appreciation when these bonds are sold 9, 12, 15 months from now. So watch that video for specifics, and if you're keen on investing in bonds, then do explore the following options. The retail direct scheme, wherein one can buy bonds directly from the RBI. Then there are fresh bond issues that are often available with your bank. Your brokerage account will allow secondary purchases. And now there are quite a few bond aggregators with stable money also expected to launch bonds in the near future. Other than the government, most public sector enterprises, so PSUs like NABARD, REC, Power Finance Corporation, the NHAI, all of these guys offer bonds from time to time. And so do corporates, although in this case you can find a range of safeties from AAA rated bonds that offer 7 to 8% and also BBB rated papers that present yields in the 13 to 16% range. My own preference in bonds are a mix of GSEC, state development loans, and some corporate bonds which are of different durations, with some maturing as early as 2026 and some as late as 2033. However, I must say my direct ownership in these bonds is not that much. It's actually very little, and much of what I have is in the form of debt mutual funds, which is what I'd like to reference in the coming section. Okay, so during uncertain times, investors often move towards debt-based mutual funds and ETFs as they serve as a reliable anchor for anyone looking to preserve capital and earn better than inflation returns. So as we all understand, a debt mutual fund primarily invests in fixed income securities like government bonds, commercial papers, corporate bonds, money market instruments, etc. And correspondingly, a debt ETF tracks an underlying debt-based index or a basket of fixed income securities like what we saw in my video on the Nifty one-day rate liquid ETF. I'm myself a big user of debt mutual funds and often deploy a mix of short duration funds like liquid and ultra short term and a few long duration funds, especially GSEC and state development loans, which normally gets packed in target maturity funds. These funds are also a part of my safety cushion, a term I explained in that video on how I've built my investment portfolio. And while in terms of credit risk, many of these short duration and long duration funds are pretty safe, when it comes to interest rate sensitivity, different funds have a different profile, as I've mapped out here, with every scheme aligning with a different use case. So to put this together, and in my opinion, a good portfolio, especially with the intention of counteracting market volatility, should have all three instruments, that is fixed deposits, bonds, and debt funds, as I presently have. But if you're going to force me to pick sides, then given the kind of interest rates that we're getting now, I'll recommend one goes for a bank FD given its simplicity, safety on account of the DICGC guarantee, and of course its high interest rates, which now goes as high as 9.5%. In times of uncertainty, another destination where travelers, investors find a lot of rest, recreation and peace are arbitrage funds. Very simply, an arbitrage fund is an equity mutual fund that aims to exploit the price differences in the cash and futures market. For example, let's say a share of Britannia Industries is available at 5,000 rupees in the cash market and 5,100 rupees in the futures market. So at the beginning of the month, we'll buy one share of Britannia from the cash market and simultaneously sell it in the higher price futures market. Now, typically on the last day of F&O expiry, both these markets, that is the cash market and the futures market, tend to converge. And that's also the time we have to reverse a position. That is, we'll have to sell in the cash market and buy from the futures market. This method is called cash and carry arbitrage, and the beauty of this is that irrespective of whether the price of Britannia goes up or down or it stays where it is, the arbitrage fund can always make money from these mispricings. Arbitrage funds offer returns in a tight band of 5 to 8% per annum and are positioned as a parking lot for investors who want to keep money aside for 3 to 9 months. What makes an arbitrage fund particularly appealing is the fact that while the return and safety it offers is like a debt instrument, its taxation is that of an equity instrument, which is why I too am an occasional user of arbitrage funds, but strictly as a short-term parking option or when I'm doing an STP, which I'll be explaining in the next section. But speaking of short-term, tell me, where are you investing for the long term? It's a rhetorical question, you don't have to answer it, but if you're looking for investing ideas, especially in the mid-cap, small-cap and micro-cap space, then do explore my newsletter where I've covered companies like BLS International, Zaggle Prepaid, Sky Gold Limited, Garware High-Tech Films, etc. And with the stock market slightly jittery, it does open up a few interesting opportunities. So read up on that. If you haven't subscribed to my newsletter, then kindly do so now and also tell your friends about it. At number 5 are the equity savings funds, another very useful investment instrument for uncertain times. It's a bit more riskier than the earlier options, but it does have its advantages. For instance, if you're someone like me who doesn't want one's incremental capital to be completely devoid of equity, but you want to merely reduce the equity exposure, then I think an equity savings fund perfectly fits the bill. This hybrid investment strategy uses a mix of equity, debt, and arbitrage in equal proportions, which means there is decent downside protection. These funds can generate inflation-beating returns, and the taxation is equity-oriented, which means STCG is taxed at 20% and LTCG at 12.5%. Yes, there will be some risks on account of the equity proportion, but just to draw this comparison, unlike the other instruments we have discussed, an equity savings fund has a wider range of returns, and when the times are good, returns here can be as high as 15% as well. So it's a bit like the decision tree we discussed in this video's introduction, but in my case, where this really helps me is when I have some lump sum money to deploy. For example, let's say I have some 20 lakh rupees. Now, given my balanced nature, I would never deploy this entire money in a bunch of equity funds or stocks or any equity-based instrument. Instead, I'll prefer to allocate this money to a couple of equity savings funds. So let's say 10 lakhs each in ESF A and ESF B. I'll then set up an STP wherein a certain sum of money, say 50,000 rupees, will be moved into a corresponding equity fund every month, which ensures I'm not risking it all during such times of uncertainty, and I also receive the benefits of averaging, which honestly has done very well for me over the past many years. The same concept applies to a savings account and arbitrage fund, and even in the case of FDs, wherein the lump sum money that's originally allotted to these instruments can then be moved into a pure equity instrument in an SIP format over the next 2 or 3 year period. Personally, I do this all the time, irrespective of whether the market is certain, uncertain, expensive or cheap. But in my case, I think it's more about comfort than anything else, and I personally believe investing should be a stress-free activity. And if you have your basics covered, then one really doesn't need to do something exotic and risky to achieve above average returns. Alright, so we've covered deposits, bonds, arbitrage and debt funds, meaning it's time for a new asset class, which is none other than equity. Surprised? Well, the typical route to equity investment during uncertain times, if you must invest, is to put your money in one of these 3 categories. The first are the non-cyclicals, so sectors like FMCG, Nestle, HUL, ITC, or pharma healthcare stocks like Dr. Reddy, Sun Pharma, or else equity players like NTPC, Power Grid, etc. The second category of note are blue chip stocks of well-established, financially stable companies with a track record of strong performance over many decades. This list would typically include companies with a large market cap, strong balance sheet with low debt, and of course a resilient business model, so basically companies like TCS, Reliance, HDFC Bank, Infosys, etc. And then to some extent, we have the dividend paying stocks which tend to offset losses during market downturns, and this would include an ITC Coal India type of companies. But today I want you to take note of a stock picking factor that seems to be doing well even during times of market uncertainty, and those are companies that are poised to show big jumps in their earnings. As evidence, I'm picking the last 8 companies I've covered in my newsletter, and if you've read them already, for some companies, a massive quarterly jump in revenues and profits was expected. More specifically, this includes BLS on account of its iData acquisition, Zaggle, which was expecting a 45 to 50% growth in revenue, Sky Gold due to its capacity increases, and Garware High-Tech Films, which is seeing higher demand for its products. Now, notice the stock price of these 4 companies before the earnings announcement. You can see here it's very volatile, and because the overall market is a bit weak, even these stocks are trending downwards. But then as the Q2 results came in, one can see the massive spurt in stock price in 3 of the 4 stocks, which makes me wonder if researching and investing in near-term high revenue growth companies is a powerful way to approach market uncertainty. Remember, I'm saying this with data because while the Nifty, Midcap 150 and the Small Cap 250 indices are down 9 to 10% in the last couple of months, most of my fast growing stock picks have done extremely well. And if you want to read more on it, then do explore the latest issue of my newsletter where I've reviewed all 8 companies. Anyways, this is my thesis and I'll continue working on it more, but I sincerely hope this simple, straightforward video has given you some ideas on what you might want to do with your money at times of market uncertainty to keep it safe and secure. Each of these instruments have their advantages and limitations. To remember, interest rate on some fixed deposits are now at 9.5%. And if you have some money you're looking to lock away for the next 1, 2 or 3 years, then do head out to Stable Money for a range of FD options and apply there using the link I've attached to this video's description and as a pinned comment. Once again, thank you for your time. Please like this video, subscribe to my newsletter, keep your money safe, and I'll see you very soon. Until then.